Hmm.
Christoph, if you're ready, I think we'll jump in.
Yeah, I'm ready to go.
Okay, so hello everyone, welcome. Welcome to today's webinar, Value Companies Using Discounted Cash Flow Analysis, brought to you by the R Consortium. The R Consortium supports key organizations developing R infrastructure through grants and sponsorships worldwide. Please visit our website to learn all the details and how your organization can become a member. My name is Jesse Kasman, today's moderator. I have just a few housekeeping items before we begin. You can ask questions at any time during the webinar. Just type your question into the Q&A window during the presentation and click the submit button. Near the end of the webinar, Christoph will try and answer as many of your questions as time allows. Okay, let me introduce Christoph Scheuch. Christoph is an independent data science and business intelligence expert. He co-created and maintains the Tidy Finance project, a transparent, open source approach to research in financial economics. The maintainers of Tidy Finance have published in leading academic journals, including the Journal of Finance, Journal of Financial Economics, Review of Finance, and Journal of Econometrics. Christoph previously held the roles of Head of Artificial Intelligence, Director of Product, and Head of BI and Data Science at the social trading platform wikifolio.com. He was an external lecturer at the Vienna University of Economics and Business, where he obtained his PhD in finance as part of the Vienna Graduate School of Finance. Christoph, thank you so much. Please take it away.
Well, thank you, Jesse, for the introduction, and thank you to the R Consortium for having us. It's been a great pleasure to host this webinar series. Unfortunately, today is the last installment, and yeah, as Jesse said, we will talk about company valuation. So let me start by sharing my slides. So maybe some of you remember in the first webinar we talked about portfolio optimization, so we only used stock return data. In the second webinar, we talked about capital asset pricing models, so how can we explain the returns of stocks. And in the last webinar in November, we talked about all kinds of financial information that you find in financial statements of companies and how we can use them to calculate financial ratios. And now in this last webinar where we talk about the company valuation, these are all topics that we will use again, but mostly I will refer a lot to the last webinar about firm fundamentals. Okay, so let's kick this webinar off. And the guiding question is, what is the value of a company? And company valuation, I think it's a critical tool that helps us to determine the economic value of a business or a project. And whether it's for investment decisions, in the context of mergers and acquisitions, financial reporting, or understanding a company's value in different contexts, this is really a big topic in corporate finance. But this valuation isn't just about assigning a number. It's also about providing a framework for making informed decisions based on these valuations. And for instance, if you are an investor into equities, you want to use a valuation to identify whether a stock is under or overvalued, or companies also rely on these valuations in the context of mergers and acquisitions or initial public offerings and stuff like that. And there are, of course, several approaches to valuation, and frankly, each suited to different purposes and scenarios. I just want to give you an overview, and because these three broad categories have a lot of different, a lot of very different approaches. And the first valuation method that I want to mention are these market-based valuations. They essentially compare the company to others in the market, often using multiples like the price to earnings ratio or enterprise value to EBITDA. It's very quick and intuitive, but you need the comparable data, which is not always the case. Another popular branch is asset-based valuation, where you focus on the net value of a company's asset. For instance, if um, you can use the book value of a company. So you just take the asset value and subtract all the liabilities, and it's very straightforward, but it doesn't really capture intangible assets like brand value or future growth potential. And the income-based method will actually be the focus of today. They really want to emphasize the company's ability to generate future earnings. And we want to provide an estimate for this. And the DCF, which is the discounted cash flow analysis, is a very popular method in this category. And it estimates the company value based on expected future cash flows, discounted to the present value. And we will talk more about this, what this actually means. It's very comprehensive, it's very useful, it's also very popular, but it requires quite a lot of assumptions about the future, and we will talk a lot about these assumptions today. Now, the discounted cash flow analysis. Why do we focus on this? At its core, from an economic perspective, it's very attractive because it accounts for the time value of money. So what is this time value of money? It means that a dollar today is worth more than a dollar in the future. So we have to discount cash flows that happen in the future. And by discounting these future cash flows back to the present, we ensure that our valuation today reflects the cost of waiting and the risk involved. And unlike methods that only rely on historical data, the discounted cash flow method focuses on future cash flows. Of course, we use the information from the past to make these predictions, but it's very useful if the business is very dynamic because the predictions, the forecasts can account for this dynamics. Well, the past has already happened, so nothing's going to change about that. Also, I want to emphasize that discounted cash flow method can be used across different industries and company sizes. So whether it's a startup or a big company or it's a tech company or manufacturing firm, you can essentially use the discounted cash flow method. And another advantage is it's not just about companies. You could also value projects using this approach, and then determine whether a project is actually worthwhile to pursue. And because the discounted cash flow method focuses on a long-term perspective and making forecasts about the future, and it incorporates risk that can arise in the future, it serves as an important foundation for strategic decision making. Yeah. Now, let's break down the key components of discounted cash flow, and then I'll give you an overview of the remainder of the webinar, because these are the topics that we will revisit throughout the webinar. The three things that you should keep in mind are first the forecasted free cash flows. This component represents the expected future earnings of the company. And these free cash flows measure the cash that remains in a company after accounting for operating expenses, taxes, investments, and changes in working capital. I will provide more details in a minute. And these free cash flows give us a clearer picture of the cash available for distribution to investors. So this is why it's really a key indicator of value. The second important concept, and again, there will be more details later again, is the continuation, or it's also known as terminal value. This value captures the value of the business beyond an explicit forecast period. that we will look at. And since these forecasting the cash flows far into the future is very uncertain, at some point we will make simplifying assumptions and to just capture like all the future value in a single number. And this will be a very important component how to calculate this. And the final component that I want you to have in mind throughout this webinar is the discount rate, which adjusts these future cash flows to the present value. So this is where the time value of money comes in through the discount rate. And typically we use the weighted average cost of capital. Again, there will be details later. And this weighted average cost of capital captures the costs that equity holders and debt bear, and it's weighted by the proportion of the company's capital structure in the respective liability class. In practice, getting this discount rate right is very crucial because this heavily affects the final valuation. This is also a topic that we will revisit later. So, outline of the webinar. We will load financial data. As every webinar, we start with actual data. Then we will look at these forecasted free cash flows. The second component comes afterwards, the continuation values, and then the third component, we will calculate discount rates. And as a last step, we will put everything together, interpret it a bit, and talk about sensitivity analysis. So what happens if we challenge key assumptions? Loading the financial data happens just as last time when we talked about financial statements. So we decided to use the data available through the financial modeling prep API, and we built a small early stage R package that you could download from GitHub. It's very easy to install and use. And once you have this package, it's also very simple to download the data that I use here in this webinar. The packages that I'm using are the tidyverse for data manipulation and overall grammar, the tidy finance package, our own package to download additional financial data that we will use later, and the FMP API package that allows us to download financial statement data. We will focus on valuing one of the biggest and most important companies, Microsoft. It's just an illustration. Of course, valuing Microsoft is tremendously difficult because it is just a huge company. It has so many areas where it operates, different income streams, and so it's just so keep in mind this is an illustration. I'm not doing a serious evaluation of a company. I'm providing the tools how you could potentially evaluate any company. But the good thing about Microsoft is that all these items and data that we need is readily available. And we will use two parts of the financial statements. So the income statements and the cash flow statements. So remember, actually, there are also balance sheet statements that we discussed in the last webinar, but we're not going to use them today. Now let's talk about the free cash flow. And I think understanding this free cash flow is essential because, as I mentioned before, it represents the cash available to investors, means both equity and debt holders, after a company has met its operational expenditures and capital expenditure needs. So this is the formula that we have in the center of the slide, and let's break it down step by step. So it starts with EBIT, also a concept that we have discussed last time. These are earnings before interest and taxes. So that's the baseline measure of operating profitability. And from there, we do a couple of adjustments. We add depreciation and amortization. So these are non-cash expenses that allocate the cost of tangible and intangible assets over their lifetime. Then we subtract taxes, so the total amount that the company pays to the government. Then we have to add the change in working capital, which is the change in current assets minus current liabilities. And it intuitively just reflects the cash needed to support daily operations. And last but not least, we will also subtract the capital expenditures, typically abbreviated as CapEx. These are the funds used by a company to acquire or upgrade physical assets, such as property, buildings, or equipment. And I just want to mention for completeness that there are alternative ways to define free cash flow. So in the slides, I provide a link to Investopedia. And of course, at the end of the presentation, I will also tell you where you can find the slides. Now let's calculate these free cash flows. So we start with the income statements and calculate EBIT. And as we discussed last time, so EBIT is the sum, we take net income, we add income tax expensive, subtract interest expensive, and also subtract interest income. And the good thing is that in the cash flow statements, we also have revenue that we will use later, and depreciation and amortization, and the taxes are already defined in the original data. And then from the cash flow statements, we will get the change in working capital and the capital expenditure. Sorry. And then we can calculate the free cash flow just with the formula that I have explained before. So it's EBIT plus depreciation and amortization minus taxes plus the change in working capital minus CapEx. And just to take a look at the data, so we have a table with 5 rows because we have 5 years of data between 2020 and 2024, and the columns that I've just described. Now let's talk about forecasting these free cash flows, because now we have just calculated the free cash flows for the last 5 years. And forecasting the free cash flows typically involves a balance between a data-driven analysis and an informal judgment. And historical data, of course, is an important foundation for these valuations. But about the future, you have to make educated assumptions. And this is what also analysts do in practice. And the first step is to express the components of the free cash flow as financial ratios relative to revenue. Makes it just more easier to create to forecast dynamics, as you will see in a second. So we have a CapEx to revenue ratio and a change in working capital to revenue ratio and stuff like that. And then typically you have to look at the business, really, what is the company doing and what is the outlook of the future, and make a guess about the future dynamics of these ratios. And if we have made a guess about the dynamics of the ratios, if we are also able to make a good forecast for the revenue growth in the future, for instance, by taking macroeconomic outlooks, then we also have forecasts for the capital expenditure and the other variables that we need. Now let's look at the financial ratios first, and then we talk again about forecasting. So I define a couple of new variables. So the first is, I mentioned before, we will look at revenue growth. So that's just revenue divided by the lagged revenue minus 1. And then the financial ratios, so all the variables that we need for free cash flow divided by revenue. So we have the operating margin, which is EBIT divided by revenue. We have the DA margin, which is depreciation and amortization divided by revenue, taxes to revenue, and the change in working capital to revenue, and finally, CapEx to revenue. So let's take also a look at these ratios. So I'm creating a figure where on the x-axis are the years, and the y-axis there are the financial ratios. So there's a lot happening on this figure, but just what I want to highlight, a couple of things. The operating margin, that's the blue line on the top. You see that there's actually it's pretty good, and it's also slightly increasing over time. So it seems over the last 5 years, in terms of profitability, Microsoft has improved. Then what's also interesting is the CapEx to revenue. I mean, it's negative because capital expenditures are typically negative, and it's also slightly decreasing over time. But this means that there are more capital expenditures happening in the future. There are more capital expenditures happening now than there were 5 years ago. And the other ratios, so the DA margin and the taxes to revenue, they are slightly above 0%, and the change in working capital is meandering around 0%. Now, actually, so if I were a financial analyst, I would have to sit down and maybe look at the longer time period of data and read financial statements and news about Microsoft, and then make some guesses about how these ratios might behave in the next couple of years. I'm just making a couple of ad hoc guesses. So this is the table on the top. I will explain them a bit why I made these, how I came up with these forecasts. And so we're just updating the figure that we had before by adding the forecast period. So I'm adding another 5 years. And again, this is not a serious valuation of Microsoft. I'm just making ad hoc guesses to make this more interesting, and to show you how this you could do this in your own context. And for instance, on the top, the operating margin. So I just assumed that will slightly grow over time, as it did in the last couple of years. And there's the AI boom happening, and Microsoft is still a big player and is involved in all kinds of things. And I'm just confident that they will become more profitable over time. Then the red line at the bottom, so I assumed in the next 2 years the capital expenditures will increase because of this heavy AI competition, but then I believe that afterwards the capital expenditures will go slightly back to their original value. And another thing that I want to mention, the purple line, the taxes to revenue. So I also assume that in this setting that Trump administration will lower taxes, and so Microsoft will have to pay lower taxes. But what this illustrates to you is that we can really, by forecasting these ratios, they can all have different dynamics. And the cool thing is now, if we're able to forecast revenue, we can also forecast EBIT because we have defined this ratio over the time. We can also forecast the capital expenditure just by really providing a forecast for revenue growth. And it's important to have these dynamics because different parts of a business might behave differently over time, as you already see by looking at the historical data that we have here. How do we forecast revenue growth? That's also a difficult topic. I'm just making a very simple proposal here, because I think a good starting point for revenue growth is to look at macroeconomic growth. And what I'm doing here is that I'm getting the current data from the IMF World Economic Outlook for the US. The International Monetary Fund publishes these analysis of global economy, and it includes trends and forecasts on a country level. And I mean, keep in mind we're talking about macroeconomic data, so it's typically lagged. But the cool thing is that the last forecast update was in October 2024, so we have fairly recent data here. And I'm just picking a simple approach. Again, you can make this more complex, how to forecast revenue growth and also which model to use. But I'm just using a simple model where I model revenue growth as a linear function of GDP growth, as you will see in a second. But of course, another approach, if you have access to the data, you can look up consensus analyst forecasts. I have mentioned before, financial analysts do these kind of things, so they also make forecasts about revenue growth. And there are some data sources that you can look up to get this information, so you don't have to forecast revenue yourself. But if you want to do it, this would be a simple approach that I'm presenting here. Okay. So what I did first, since there is no good way to access the data from the World Economic Outlook table, I copied the stuff to the script. So for the years 2020 to 29, these are the growth rates that are the GDP growth rates that are on the IMF data website. And then I'm estimating a very simple linear model with just 5 data points. So the revenue growth regressed on the GDP growth. Obviously, it would make sense to use a longer time series, but just to keep it simple here. And now we can use these coefficients for the linear model. So I define the revenue growth modeled variable by taking the first coefficient, so the intercept of this linear model, plus the slope coefficient of this model times the GDP growth that we get from IMF. So now I have actual revenue growth of the company from the past, but we are in our data, and I have forecasted revenue growth based on a simple linear model. And now if we look at the GDP growth and revenue growth, it's actually not that exciting, to be honest. So the blue line is the revenue growth of Microsoft, which is far more dynamic than the GDP growth for the United States. And you see that the forecasts for the GDP growth in the United States are fairly flat, so it's not a big surprise that the forecasts for the revenue of Microsoft are also very flat. This would mean that my model is probably not the best model to forecast the revenues of Microsoft. But then again, just want to keep it simple here and show how we can piece things together. Now we have everything to calculate the free cash flow forecast, because if we have the revenue growth for every point in time, we can calculate the revenue for the future periods. And once we have forecasted the revenue, we can just calculate the components of the free cash flow by multiplying revenue with the financial ratios that we have also defined already before. Now, I think what's the most interesting part is how do these free cash flows look like. So on the x-axis, we have the years again, and the y-axis, I'm plotting the free cash flows in billions of dollars. And you see that this forecast model predicts a steady increase in the free cash flows of Microsoft. Okay, first component done. So we have free cash flows in a very simple framework. Let's talk about the continuation value again. As I said before, you can also call it terminal value, but I like I prefer the term continuation value because it's not like after these 5 years of forecasts, Microsoft dies, but we just assume that the company will just continue to operate until infinity. And the typical approach here is to use the so-called perpetuity growth model. So in the first 5 years of our forecast period, we model the financial dynamics and we do our analysis, we make an educated guess. But afterwards, we just assume that it's a very simple growth model. So in particular, it means that we assume that the free cash flows grow at a constant rate indefinitely. And what we have here is the ratio of the last free cash flow divided by the difference between the discount rate and the perpetual growth rate. So we have to make an assumption for the perpetual growth rate. For instance, the last 20 years of GDP growth is, I believe, a sensible guess. And it was actually 4% for the United States. And the discount rate we will talk about in a second. I just want to mention also that there is another popular approach here to estimate the continuation value by looking at the multiples of EBITDA. So this is the so-called exit multiple approach. I'm providing the link here. If you're interested, you can look it up. Now let's calculate this continuation value with perpetuity growth. So I'm defining a little function that implements exactly the formula that I've said before. So we take the last free cash flow multiplied by 1 plus the growth rate. So we get like the next period free cash flow and then divided by the discount rate minus the growth rate. And just as an example, if we calculate the terminal value using the growth rate of 4% and the discount rate of 8%, then we will get a terminal value of 7,500, so 7.5 trillion dollars. So that's a lot of money, but then again, we're talking about Microsoft, so it's maybe not that unrealistic if we assume that Microsoft is expected to grow indefinitely. So we have forecasted free cash flows. We have a notion. We have also calculated the continuation value. So the third part that is missing now are the discount rates. And again, discount rates are important because we want to bring these future cash flows to the present value. Again, keep in mind, time value of money is important. And in most cases, for this discounted cash flow analysis, people use the weighted average cost of capital, also called WACC. And this WACC represents the average return required by all the company's investors, including both equity holders and debt holders. And it reflects the overall cost of financing the company's operations. And it also serves as the discount rate in our valuation. So here in this formula, you have E, that is the market value of the company's equity. D is the market value of the company's debt. And then we have the corresponding rates of return. So R, the E is the required return on equity, which is often calculated using models such as the capital asset pricing models, a capital asset pricing model that we have discussed in the second webinar. And the RD is the pre-tax return on debt. And it's essentially the interest rate that the company pays on its borrowings. And also in this formula, we have the tax rate. because interest payments on debt are tax deductible. So we have to add this here to reflect this after-tax cost of debt. There are many components to this WACC, and if you want to estimate this yourself, you can do it. It's a bit cumbersome, so because we don't have that much time, I'm not going to do it here. I'm going to use a data source for this. But if you want to do it, if you want to try it, you just a few hints. So equity is typically, so it is measured by the market value of the company's equity, and one common approach is to calculate it by subtracting net debt from the enterprise value. For debt, apparently, one of the shortcuts that people often take is just use the book value of the company's debt. It's not perfectly reflecting market conditions, but it's usually a very practical starting point when market data is unavailable. For Microsoft, you also have bonds that are trading. So you could also look at the discount of those bonds and use it to transform the book value of debt to some measure from the market value. The return on equity is typically estimated by the CAPM, which I mentioned already before. And RD can be estimated in two ways. At least the two ways that we thought are worthwhile to explore. At least two ways, or probably more. The first is you can calculate effective interest using financial statements. So you find interest expenses and total debt in the financial statements, and you can just divide the interest expenses through total debt. And another way is to look at bond spreads. So all the public companies have a credit rating, and you know that Microsoft is in the best rating category, at least as far as I know. And you can look at the difference between bonds in these rating categories to the risk-free rate and use this information to estimate these borrowing costs. So, but these are just some ideas. What we are doing here in this webinar is we use a very popular data source. So Aswad Damodaran has provides estimates for the WACC. It's very heavily used. He's a professor at NYU Stern and maintains this extensive database. It's not just discount rates, but also cash flows, growth rates, multiples, and more for sectors, companies, countries, you name it. So what we are doing here now, I'm just providing the code. So we are downloading an Excel file from his website that contains the WACC for the computer services industry, because this is the industry where Microsoft is operating. But of course, if you look at the data, you can, for your application, pick different WACCs. And what we have here as a cost of capital is about 7.4%. Is how in the recent estimates in the Damodaran web database. Now we have everything. So we have a WACC, we have the continuation value, and we have forecasted free cash flow. So now let's bring everything together. The total discounted cash flow value is the sum of these free cash flows discounted by our discount rate. And at the end, we have the terminal value also discounted by the discount rate. So what we're doing now as a final step is basically putting all the functions that we've introduced before together and define a single compute DCF function. And what this function does is just takes all the assumptions that we have made about the financial ratios and as an input the WACC and the growth rate, the perpetual growth rate at the end, and calculates the total discounted cash flow value. So what this model spells out is that the total discounted cash flow value of Microsoft as of today is 6 trillion. So a lot of pieces have, a lot of things have do influence this value. And this is actually a key challenge in the discounted cash flow analysis. And we could probably do a whole webinar on extending it and looking at different assumptions and stuff like that. Because we have made assumptions about the future, about revenue growth, or even GDP growth, and about risk in the form of the discount rate. This is why it's very important to, if you do this kind of analysis, to also consider how sensitive your outputs are if you change your assumptions. And for the discounted cash flow method, I'm just showing you a simple example. How we can perform such a sensitivity analysis and quantify the effect of changing some of the inputs. In particular, we will look at the perpetual growth rate and the WACC estimation. But if you download the code, you can also play around with defining different forecast ratios and coming up with different short-term revenue forecasts and look how this affects the valuation. Why I'm picking the perpetual growth rate and the WACC estimation, it's because, as you will see, changing them slightly has tremendous impact on the terminal value. So how do we do this? In the example here, I'm defining a range for the WACC and the perpetual growth rate. So we had a WACC of 7.4%, the estimate from the database. But now I say, okay, what if I vary it between 6% and 8%? So this is like a range of meaningful WACCs. And for the growth rate, we had 3% for the perpetual growth rate. That's just varied between 2 and 4%. So it's not a big range, but as you see, this has a huge impact. So I'm creating a grid using these values, and then I can just map the function that we've defined before, the compute DCF function across those inputs, and I get a grid of company valuations. So what I'm plotting next is on the x-axis the WACC and on the y-axis the growth rate. These are the things, the assumptions that we're varying, and this geom tile plot, the fill will be the company value. And you can see here, the value varies a lot. So in the middle, this is closer to the estimate that we had before, about 6.7 trillion. But if we lower the WACC to 6% and increase the perpetual growth rate to 4%, then this would be more than 12.7 trillion. So, and I think it's very important to keep this in mind that this discounted cash flow analysis is a popular tool and it's widely used, but it rests on very sensitive assumptions. And if you do this, it's just important to play around with your assumptions. Okay, before we wrap this up, I just want to mention, if you want to take the discounted cash flow value and get the equity value from it, just have to keep in mind that the discounted cash flow provides an estimate of the value of operations, and we still need to adjust this to reflect the full picture of the company's equity. So in particular, we have to account for non-operating assets. These are assets that don't directly contribute to the company's core operations, but still hold some value, like marketable securities. vacant land or idle equipment, stuff like that. And also we have to subtract the value of debt, which reflects the company's obligations to lenders. In theory, this should be the market value of total debt, which accounts for factors like interest rates and credit risk. But since these, in particular, the non-operating assets are not readily available in financial statements, we'll leave the calculation and the calculation of equity value as a potential exercise for the future. And with this, I arrive at the end of the webinar. Again, I know this has been a lot of content, but here are the key takeaways that hopefully you keep in mind. First, the DCF method provides a structured framework for making informed decisions, in particular by breaking down the valuation process into clear logical steps. And it helps analysts and decision makers to focus on fundamentals and the assumptions that drive the valuation. The DCF stands out because it values companies based on their projected future cash flows rather than just looking at the historical data or some market sentiment. And it makes it very useful for long-term strategic thinking. And the three core elements that we discussed are the free cash flow, the continuation value, and the WACC. And finally, if you ever play around with this, try to validate your assumptions or at least challenge them, because the quality of the DCF analysis depends crucially on these assumptions. So thank you everybody for participating. We really enjoyed creating this webinar series. You can find all slides and recordings at talks.tidyfinance.org. I will also upload the slides later today. And now I'm happy to answer a couple of questions if there are any. And I'm sorry about my voice because I was sick for the last couple of days. So, but I hope it was fine. All right. So there's one question. The consensus analyst forecast data you mentioned comes from IBES, right? Yes. So IBS is the most popular data that I am aware of, in particular in academic contexts. This is what people use. I'm pretty sure that I mean, there has been a tremendous growth in financial data providers. I think even this FMP API that we use provides forecast data. You can also look up some revenue forecasts about Yahoo Finance. Yeah, and probably many sources, but IBES is the one that I also know from academic context, yes. Okay. Is there any more questions? I'm happy to answer them. Maybe I also take a minute to mention that the content of these webinars, so the 4 topics that we have discussed, we plan to create standalone chapters on tidyfinance.org, where we will probably extend the code, provide a lot of written context, what we're doing. And we would be happy to get your feedback once the stuff is online. So if you're interested in these topics, make sure to check back at tidyfinance.org, or follow us or me on LinkedIn. And I will promise to post updates around this. Okay. If there are no further questions, we're going to stop here. Um, Thank you everybody for joining, and yeah, have a good day or night wherever you are in the world. Bye.